How you rebalance the portfolio when the correlation between bonds and equities start to pick up again. We saw this a couple of Fridays ago when we got the payrolls report, and I see it playing out in the price action on my screens all over again. Mihir, how do you handle that?
Right. So when the market is rethinking inflation, especially on the upside, you get episodes like we saw and like we're seeing today, where stocks and bond prices are both going down at the same time. So one is you've got to rethink your correlations, not just between stocks and bonds, but across all assets, and on the margin, rebalance away from financial assets like stocks and bonds, and make sure that you've got the correct allocation to real assets like tips, commodities, real estate, REITs, MLPs. So that's the process folks should be thinking about. While I say that, in a shock or in a recession, it's clear that the only asset that does well is bonds. So in that case, the correlation won't go away. But there's many new areas of the distribution where stock and bond prices could be going down at the same time, and people should be aware of that.
Stephen Parker.
Well, I think in the long run, as long as you're not talking about an inflation shock, a little bit of inflation is actually a good thing for stocks. It means that there's some pricing power, which is good for earnings. And in fact, if you see even a little bit higher levels of inflation, that typically means this is sort of the sweet spot from a valuation perspective. So I still think that when you're doing the calculus between stocks and bonds, stocks are where you want to be. I agree you want to be increasing some of that commodity exposure, whether that's through the commodities directly or through some of the energy companies or the mining companies. But I still think that the outlook for the equity market is good.